The stock market is rigged and crashes are inevitable. Think that's controversial? Stick around, we've got some eye-opening insights coming your way. You see, the stock market is a bit like a roller coaster, full of exhilarating highs and terrifying drops. And just like a roller coaster, market crashes are a part of the ride. They're not anomalies or mistakes, but integral parts of the market's cyclical nature. But why do they happen? Well, the reasons can range from economic slowdowns to geopolitical instability to excessive speculation and even black swan events. This complex dance of factors can sometimes create a perfect storm leading to a market crash. Now, wouldn't it be great if we could predict these crashes? Well, brace yourselves, we're about to dive into the signs of a looming market crash. First up on our crash radar, overvalued stocks and inverted yield curves. Overvalued stocks, what are they? Simply put, an overvalued stock is like a designer handbag priced at $1 million. Sure, it's pretty and all, but is it really worth that much? When a company's stock price is higher than its intrinsic value, that's when we say it's overvalued. It's like paying for a gold bar and getting a chocolate coin in return. Not exactly what you signed up for, right? Now, why is this a problem? Overvaluation often leads to a market correction, and this correction can sometimes be a steep, sudden fall. Picture a roller coaster that only goes down. Not the fun kind, huh? Now let's move on to the enigmatic inverted yield curve. Think of it as a topsy-turvy world where long-term investments yield less than short-term ones. It's like planting a tree and expecting it to bear fruit the next day, while your potted plant takes years. Doesn't make sense, right? An inverted yield curve is a classic sign of an upcoming recession. Why, you ask? Because it shows that investors are more confident in short-term prospects than in the long-term outlook. These two signs, overvalued stocks and inverted yield curves, are like the weather forecast for the stock market. When they appear, it might be time to grab your umbrella because there's a storm coming. So, if you see overvalued stocks and inverted yield curves, it might be time to brace for impact. Now don't panic. There's always a silver lining. Knowledge is power, and being aware of these signs gives you the power to make informed decisions. Just like a well-prepared hiker facing a storm, you too can navigate through the turbulent market with the right tools and the right mindset. Stay tuned as we dive deeper into the signals that could predict a market crash. Up next, we'll be discussing interest rate hikes and black swan events. But wait, there's more. Interest rate hikes and black swan events also spell trouble. Let's talk about interest rates for a moment. You see, when central banks raise interest rates, it can put a real strain on the economy. This is because higher interest rates make borrowing more expensive, which can discourage businesses from taking out loans to expand or invest. Consumers might also cut back on spending, especially on big-ticket items that are often financed through loans, like houses or cars. When interest rates are hiked successively, the pressure on the economy can become too much to bear, leading to a slowdown or even a crash. It's like tightening a screw. A little pressure can be good, but tighten too much and too quickly, and the screw might just snap. Now let's turn our attention to black swan events. This term, coined by the scholar 𝗗𝗜𝗦𝗖𝗢𝗓, refers to unpredictable events that have potentially severe consequences. Black swan events are characterized by their extreme rarity, their severe impact, and the widespread insistence they were obvious in hindsight. A black swan event could be anything from a natural disaster, a war, a pandemic, to a financial crisis. It's the kind of event that can send shockwaves through the market, causing severe drops in stock prices. The challenge with black swan events is that, by their very nature, they cannot be predicted. But they can and do occur, and when they do, they can trigger a market crash. So, how can you protect yourself? Well, the key lies in diversification and risk management. By spreading your investments across a variety of asset classes and sectors, you can better protect yourself from the potential fallout of a black swan event. And by keeping a close eye on interest rates, you can position yourself to react swiftly and appropriately to any successive hikes. So keep a close eye on interest rates and stay alert for those unexpected black swans. Complacency and increased volatility, the dynamic duo of disaster. These two seemingly contrasting elements can paint a dangerous picture in the world of investing. Let's talk about complacency first. Complacency in the market occurs when investors become overly confident, ignoring the warning signs that their investments might be overvalued. This overconfidence can lead to a false sense of security, and investors may neglect to properly manage their portfolios. They might also disregard potential risks, trusting too much in the stability of the market. The danger here is that when the market does take a downturn, these investors are often caught off guard, leading to panic selling and exacerbating the crash. Now on the other side of the spectrum is increased volatility. Volatility is a measure of the price fluctuations of a security or market index. Normally, some level of volatility is expected and even healthy for the market. It allows for price adjustments and provides opportunities for investors. However, when volatility increases significantly, it can indicate uncertainty and instability in the market. Increased volatility can be a sign of an impending market crash. High volatility often means that the prices of securities are changing rapidly in a very short time, making it possible for massive losses. This can lead to a market-wide panic as investors rush to sell off their holdings to avoid further losses, thus triggering a crash. In the world of investing, balance is key. Too much complacency can blind investors to the risks that lie ahead. On the other hand, high volatility can create an environment of fear and uncertainty. These two elements, when they appear together, can create a perfect storm leading to a potential market crash. As investors, it's crucial to stay vigilant and balanced. Don't be lulled into a false sense of security when the market is calm, and don't be swayed by fear when the market is tumultuous. Always keep a keen eye on the market indicators and adjust your strategies accordingly. Remember, too much calm or too much chaos can both signal a storm on the horizon. Next two red flags are economic slowdown and excessive speculation. These two are important red flags to look out for in our crash countdown. When we talk about an economic slowdown, we're referring to a decrease in the rate of economic growth. This could be a result of various factors like a fall in consumer spending, a drop in manufacturing, or a slump in business investment. In other words, when the economy's engine starts to sputter, it's a sign that we're heading for a downturn. Now you might ask, why does an economic slowdown matter for the stock market? Well, the stock market is like a mirror, reflecting the health of the economy. If the economy is flourishing, the market usually follows suit. But if the economy is slowing, the market can stumble. This is because a slowdown can squeeze corporate profits, and when profits fall, stock prices often follow. Then we have excessive speculation. This is when investors start buying stocks not because of their underlying value, but because they expect prices to keep going up. It's like a game of musical chairs. Everyone's having fun while the music is playing, but when the music stops, there's a scramble for the few remaining chairs. Excessive speculation can destabilize the market, creating a bubble that can burst at any moment. When this happens, prices can plummet, triggering a crash. Remember the dot-com bubble in the late 90s, or the housing bubble that led to the Great Recession? Both were fueled by rampant speculation. So, if you see signs of an economic slowdown, or if speculation seems to be getting out of hand, it's time to be vigilant. Remember, the stock market is not a casino. It's a place for investing, not gambling. So, if the economy is slowing and speculation is running wild, it's time to buckle up. Before we wrap up, let's take a moment to discuss two additional red flags that could indicate a looming stock market crash: insiders dumping their own stock and high-margin debt. Firstly, when company insiders, the CEOs, CFOs, board members, and others privy to the inner workings of their companies, start selling off their own shares, it might indicate they expect the stock price to drop. This isn't a foolproof sign, as insiders sell their stock for various reasons, but it's definitely a trend worth monitoring. The last red flag to talk about is high-margin debt. This refers to the money investors borrow to buy more stocks. When margin debt levels are high, it implies that investors are overly confident and possibly over-leveraged. If these investors suddenly have to sell their stocks to pay back their loans, it can trigger a market crash. So, keep an eye on these two indicators: insider trading and margin debt levels. They could be the canary in the coal mine, warning you of potential danger ahead. So, there you have it, folks. The stock market is a wild ride, but with these signs you can at least see the bumps ahead. It's important to recognize the warning signals, from overvalued stocks and inverted yield curves to interest rate hikes and unexpected black swan events. Being aware of these indications is key to maintaining a strong footing in the financial terrain. Moreover, it's crucial to stay informed and adjust your strategy as the market evolves. Complacency can lead to chaos, so it's crucial to adapt and diversify our portfolios as needed. Let's not underestimate the power of knowledge and preparedness in the world of investing. As we've said before, knowledge is power, so stay informed and stay savvy. Remember, it's not about predicting the future, but about being well-equipped for whatever comes our way. So let's keep learning, let's keep growing, and let's make informed decisions. More insights coming your way in our next video, so don't forget to hit that subscribe button. Until then, stay savvy out there.